Imagine putting like $1,000 a month into a textbook, supposedly responsible retirement portfolio for 30 years.
Right. The classic balanced approach.
Exactly. But then you find out that being responsible actually cost you $300,000.
Ouch. Yeah, that's the price of a whole house.
Just gone.
Yeah.
And that's not a hypothetical. That is the startling reality a Reddit user recently uncovered when they ran this massive backtest comparing a traditional blended portfolio to just a pure 100% stock portfolio.
It's sobering for sure.
It really is. So, I mean, if you are looking at your own retirement accounts today and you're seeing your equities bouncing around while your bonds are just, sitting there doing nothing, you have to ask the question.
Are they actually helping?
Right. Are bonds actually an anchor keeping your financial ship steady, or are they literally just dead weight dragging your returns through the mud?
It's the ultimate dilemma for anyone trying to build a resilient portfolio in 2026. Because, we've been conditioned for decades to believe that a balanced mix absolutely requires a safe, fixed income cushion.
The classic 60-40 or 50-50 split?
Precisely. But when the underlying mechanics of the global market shift, like when inflation acts up or central banks drastically change their tune, that supposedly safe cushion can suddenly feel, well, awfully thin.
Yeah, completely. So welcome to this deep dive. Our mission today is to settle this debate once and for all for you. We're looking at whether bonds are still a necessary evil, how interest rates are fundamentally altering their performance, and if they are struggling, whether dividend ETFs are the ultimate safe haven for generating income and protecting against downside risk.
And we have a really fantastic stack of source material to help us figure this out.
Oh, it's huge. We're synthesizing the 2026 Fidelity Bond Market Outlook, decades of historical academic data from NYU Stern, strategic risk analyses from Vanguard and Citi Private Bank.
Plus some head-to-head ETF showdowns from the Motley Fool.
Yes. And of course, those raw, completely unfiltered retail investor debates straight from Reddit.
Which I love because it gives us this multidimensional view. We're looking at high-level macroeconomic theory right alongside the ground level.
Yeah.
Very real anxiety of people just trying to figure out how to retire without, running out of money.
Exactly. Now, really quickly, because we are pulling from such a wide array of sources, including some highly opinionated retail debates, I want to be crystal clear up front. We aren't taking sides or endorsing any specific political or financial strategy today.
Right. No endorsements here.
Our job is strictly to unpack the data impartially and convey the ideas from the source material so you can make up your own mind. So, okay, let's unpack this because I want to go back to that $300,000 gap I mentioned at the top.
Reddit backtest.
Yeah. The user looked at a 30-year career. If you did a traditional 50-50 split, so half in a general bond fund, half in a total stock market index, you end up with about $1.1 million by March of 2025.
Which is, a solid, respectable number. Most financial planners would be thrilled with that.
Sure, yeah. But if that same investor had just completely ignored the conventional wisdom and gone 100% into the stock market index, they would have $1.4 million.
A huge difference.
So I have to play the skeptic here. Why bother with bonds at all if they are mathematically proven to drag down your returns by that much over a working career?
Well, looking purely at the terminal wealth number definitely makes that a compelling argument.
Yeah.
I mean, nobody wants to leave 300 grand on the table.
Exactly.
But if we pull back and look at the Fidelity 2026 outlook, the landscape is much more nuanced than a simple 30-year rearview mirror. First, we need to establish that bonds haven't been entirely dead weight recently.
Okay, fair.
The Bloomberg U.S. Aggregate Bond Index, which is basically the benchmark that tracks the total performance of the entire U.S. investment-grade bond market, so everything from treasuries to corporate debt, it actually returned about 7% in 2025.
Wait, 7%? That's practically a historical stock market return.
It is. But to understand why bonds are behaving this way right now, we really have to explain the actual mechanics of interest rates.
Right, because we usually just hear that tired old seesaw analogy, rates go up, prices go down.
Yeah, which is true, but it doesn't really explain the why.
No, it doesn't. Let me actually visualize this a different way for you listening. Imagine you are a landlord.
Okay, I like this.
You lock a tenant into a 10-year lease at, say, $1,000 a month. You're happy. But a year later, inflation spikes, the neighborhood booms, and identical apartments right down the street are suddenly renting for $2,000 a month.
Ouch. Your building's resale value just plummeted.
Exactly. Well, wait, let me finish the thought. Because if you try to sell your apartment building, any buyer is going to look at that lease and say, why would I pay top dollar for your building when I'm stuck with this terrible $1,000 contract for the next 9 years?
Right, they wouldn't.
So you have to sell the building at a massive discount just to compensate them. And that is exactly what happens to a bond. If you hold a bond paying 3%, and the Federal Reserve raises rates so new bonds pay 5%.
The resale value of your old bond tanks.
Yes, because nobody wants your inferior contract.
That landlord analogy perfectly captures the mechanism of interest rate risk. And what the Reddit debate inadvertently highlights is a fundamental miscalculation of that exact risk by major institutions recently.
Oh, you mean the banks?
Yes. Over the last few years, banks themselves were acting like novice landlords. They locked up billions of dollars in long-term bonds during the pandemic era when rates were sitting near zero.
Which seemed fine at the time.
Right, until the Fed aggressively spiked rates to fight inflation. Then the resale value of those 0% bonds cratered, leaving the banks massively underwater.
Hold on, though. I have to push back on this using a brilliant critique from one of our Reddit sources.
Okay, let's hear it.
They pointed out that from 1980 all the way to 2021, we experienced this historic 40-year bull run of declining interest rates. I mean, Paul Volcker hiked rates to the moon in the 80s, and then they basically fell steadily for 4 decades.
That's true. It was a massive tailwind.
Right. Every time rates ticked down, those older, higher-yielding bonds became more valuable. So isn't betting on historical bond performance kind of a rigged game? If that 40-year tailwind of dropping rates is permanently over, why should we expect bonds to save us in 2026?
If we connect this to the bigger picture, the transition out of that 40-year tailwind is the exact friction the market is wrestling with today. Fidelity's research notes that we are finally seeing the normalization of what is called the term premium.
Term premium, meaning like the extra compensation I demand for locking up my money.
Exactly.
Because if I'm going to lend you cash for 10 years instead of 2 years, I am taking on way more inflation risk and opportunity costs. So I demand a higher interest rate for that uncertainty.
That is the textbook definition, yes.
Yeah.
For a bizarre stretch recently, we had an inverted yield curve, where short-term lending actually paid more than long-term lending. But the term premium is returning.
Okay, so things are normalizing.
Right. And the critical takeaway for 2026 is this. Even though the Fed cut its benchmark short-term rate by nearly 2 percentage points over the last year and a half, intermediate and long-term yields have remained stubbornly high.
Because the market forces of supply and demand, like the global investors actually buying these bonds, they're demanding that premium regardless of what the Fed dictates for overnight lending.
Exactly. Which brings us to Fidelity's core thesis. They argue this creates a highly attractive fair value entry point today.
How so?
Because you're starting with a much higher baseline yield, say 4 or 5% instead of 1%. You have a built-in mathematical cushion.
Oh, I see.
If inflation flares up, rates rise further, and your bond's price falls a bit, that hefty annual interest payment you are collecting helps offset the paper loss in the bond's price.
So the villain here isn't the bond itself. It's the unpredictability of the interest rate environment.
Completely.
Which leads directly into strategy. Because how do we actually manage that unpredictability? One of the most popular strategies I saw across our sources is the bond ladder.
A classic strategy.
Yeah, I like to think of a bond ladder as a conveyor belt of cash. Instead of taking all your money and buying one giant bond that matures in 10 years, you chop your money up. You buy a 1-year bond, a 2-year bond, a 3-year bond, and so on.
Right, and it forces you into this really disciplined cycle of reinvestment.
Exactly. When that 1-year bond matures and pays you your principal back, you take that cash and place it at the back of the conveyor belt, buying a new, let's say, 5-year bond.
And the beauty of the conveyor belt is that it naturally hedges against whatever the market is doing. If rates have skyrocketed, great. Your short-term bond just matured, and you get to buy a new one at that awesome new high rate.
Yeah, and if rates have crashed, well, you don't care as much because you still have your older bonds locked in at the previous high rates further down the line.
Now, the Greenbush Financial Source outlines 3 distinct architectural blueprints for building this ladder. And your choice depends entirely on what you expect the economy to do.
Okay, what's the first one?
The first is the equal-weighted ladder, which is basically the classic conveyor belt you just described. It's the set-it-and-forget-it mode for investors who acknowledge they cannot predict interest rates and just want smooth, continuous exposure.
Makes sense. But if you do have a strong opinion on the market, Greenbush brings up the barbell strategy.
Yes, the barbell. Heavy weights on the ends, nothing in the middle.
So like skipping the medium term entirely.
Exactly. With a barbell, you might put half your money in extremely short-term bonds, like 1 month to 1 year treasuries, and the other half in 10-year or 20-year bonds. You skip the intermediate years entirely.
Why would someone do that?
You'd choose this if you need immediate, absolute liquidity on one end for living expenses, but you simultaneously believe long-term rates are about to plummet, so you want to lock in today's high yields for the next decade.
Right. Okay. And if that sounds too extreme, Greenbush also mentions the middle-loaded ladder.
The Goldilocks approach.
Yeah, you just ignore the ultra-short and ultra-long ends and pack all your money into the 3 to 7 year sweet spot. You aren't constantly reinvesting every single month, but you aren't locking your money away for a generation either.
It's a great middle ground. However, we do need to address a massive behavioral trap investors fall into when trying to squeeze income out of these portfolios.
Oh, reaching for yield.
Yes. To hit that traditional 4% spending target in retirement, human nature kicks in. Investors look at a safe U.S. Treasury paying, say, 4%, and then they look at a high-yield corporate bond, also known as a junk bond paying 8%.
Right. I mean, consider the temptation. You can literally double your monthly income just by clicking a different ticker symbol on your brokerage app. Why wouldn't you reach for that yield?
Because you are fundamentally altering the risk profile of your safe bucket. Vanguard and Citi Private Bank both provided extensive data that definitively shuts down this reaching for yield strategy.
What did they find?
Vanguard analyzed severe market shocks, specifically zooming in on the COVID-19 crash in early 2020. They found that high-yield and emerging market bonds do not act like shock absorbers during a panic. They act like equities.
Wait, so right when the stock market is in free fall and you desperately need your bonds to be that boring, stable rock so you can pay your mortgage?
The high-yield bonds are plummeting right alongside your stocks.
That's terrifying.
It is. Consider the capital structure of business. High-yield bonds are issued by companies with poor credit ratings, companies teetering on the edge. In a severe recession, the risk of those companies going bankrupt spikes. If they go under, the equity stockholders get wiped out. But the unsecured junk bondholders might only get pennies on the dollar.
So investors panic.
Exactly. Knowing this, investors panic and dump those bonds immediately, tanking their price. Citi Private Bank's data models echo this perfectly. In worst-case economic scenarios, blended portfolios using long-duration, highly rated investment-grade bonds provide vastly superior downside protection compared to portfolios padded with riskier debt.
So if you are buying bonds for safety, the data says you absolutely must stick to pristine credit quality.
No question.
Okay, so we've established that reaching for yield in the bond market is a trap. But human nature hates a vacuum. If retirees feel they can't get enough juice from a safe bond, they inevitably start looking sideways at the stock market, hunting for a loophole.
And that loophole is usually a high-dividend stock.
Yes. They pivot and say, forget bonds. I'll just buy massive established companies that pay me cash dividends. They give me income. And because they are blue chip behemoths, they'll be perfectly safe during a crash.
NYU Stern calls this the pessimist pitch.
The pessimist pitch. I love that. And it's an incredibly seductive narrative, especially for anxious investors. The psychological comfort of seeing a cash dividend hit your account every quarter makes you feel insulated.
It really does. The theory is that even if the broader stock market crashes, these high-dividend stocks will offer solace. You might lose some paper value, but you can still pay your bills with those guaranteed payouts.
But the data shock here is wild, and it completely shatters that narrative. The NYU Stern research analyzed market data all the way from 1927 to 2001. They separated the market into bull years, neutral years, and bear years.
And the bear years are the most revealing.
Absolutely. Because they found that in bear markets, the stocks with the highest dividend yields actually delivered worse negative total returns than the stocks with the lowest dividend yields.
What's fascinating here is understanding why that happens. We have to look at the underlying mechanism of a yield trap. Let's break down the math real quick. A dividend yield is simply the annual payout divided by the stock price.
Okay, so if I buy a $100 stock and it pays me a $5 dividend every year, my yield is 5%.
Exactly. Now, imagine that company reports terrible earnings. They're losing market share, debt is piling up, and institutional investors start dumping the stock. The stock price crashes from $100 down to $50.
Yikes. Okay. But if they haven't officially announced a change to their dividend yet, the payout is still $5.
Right.
So $5 on a $50 stock, Suddenly, the dividend yield looks like 10%.
And that is the trap. An amateur investor screens for high-yielding stocks, sees a 10% yield, and thinks they found a gold mine.
When really it's a sinking ship.
Precisely. The yield only went up because the price collapsed. It's a massive red flag signaling the market anticipates trouble. When the severe recession hits, that struggling company is forced to cut its dividend to zero just to survive.
So the amateur investor loses half their capital in the price crash, and the income they were relying on just evaporates overnight.
That is exactly why the NYU Stern data shows those high-yield cohorts performing so dismally in bear markets.
Furthermore, there is a fundamental legal difference here we have to mention. A bond coupon is a contractual obligation. If a company misses a bond payment, they are in default, and creditors can drag them into bankruptcy court.
It's binding.
Right. But a stock dividend is completely discretionary. The board of directors can vote to eliminate it tomorrow morning over coffee.
Which means dividends offer zero structural downside protection.
So are dividends just a terrible idea?
Well, no, we cannot write off dividend investing entirely. If we stretch our time horizon, the story changes dramatically.
How much time are we talking?
10 years. The Sure Dividend source notes that over a 10-year period, dividend stocks thoroughly crush bonds. They point to the DVY ETF, a major dividend fund, which generated a 9.3% annualized return over the last decade.
Wow.
Compare that to less than 2% for the AGG bond ETF over the exact same period.
Okay, so if dividends are a trap and a crash, but they crush bonds over a decade, how do we reconcile those two realities?
It really comes down to volatility tolerance and inflation. Over a decade, dividend growers, so companies that consistently increase their payouts year after year, will outpace inflation because their underlying businesses are growing.
Unlike bonds.
Right, bonds with their fixed payments get eaten alive by inflation over long stretches. But those dividend stocks, they will give you a violently bumpy ride to get there. They're wealth-building engines for the long term, not a substitute for the short-term capital preservation of a bond.
Okay, so knowing that not all dividend stocks are created equal and that a juicy yield can often be a mirage hiding a dying company, how does an investor actually filter out the garbage? Let's get out of the academic theory and look at a real-world showdown.
I think the Motley Fool comparison is perfect for this.
It is brilliant. They provided a comparison between two massive, incredibly popular dividend ETFs, SCHD, which is the Schwab U.S. Dividend Equity ETF, and FDVV, the Fidelity High Dividend ETF.
Looking at these two funds is honestly like a masterclass in index methodologies.
Yeah.
If we look at the 5-year performance leading into early 2026, the divergence is stark.
Okay, give us the numbers.
If you invested $1,000 5 years ago, it would be worth $1,282 in SCHD.
Okay.
But in FDVV, it'd be worth $1,603.
Wow, that's a big gap. And FDVV utterly dominated the short term, too. A 15.7% one-year return compared to SCHD's 11.8%.
It did.
But wait, halt. Here's where it gets really interesting, because when I looked at the holdings for FDVV, you're telling me NVIDIA is a top holding in a high-dividend ETF.
Yes.
NVIDIA. Their dividend yield is virtually microscopic. It's practically a rounding error. How on earth does the algorithm for a dividend fund justify buying a hypergrowth AI chipmaker? Explain that mechanism to me.
It reveals everything about FDVV's specific screening algorithm. FDVV does not just sort by the highest current yield. Their methodology looks for a combination of moderate yield, strong historical dividend growth, and crucially, high overall earnings growth.
Earnings growth, okay.
Furthermore, the fund is market cap weighted. Because NVIDIA's earnings exploded and its total market capitalization went to the moon, it earned a massive weighting in the ETF. The tiny dividend was really just the ticket to get in the door.
And then the growth took over from there.
Exactly.
So FDVV is essentially a Trojan horse. It allows you to participate in market-leading tech rallies under the guise of dividend investing. Its portfolio is heavily tilted toward technology and financial services, so NVIDIA, Apple, Microsoft.
But that massive growth posture has a dark side.
Right. The maximum drawdown for FDVV over that 5-year period was a painful negative 20.16%.
Which brings us to the alternative. SCHD. SCHD operates with a completely different philosophy. It screens strictly for financial health metrics before it even looks at the yield.
What kind of metrics?
Two of its primary screens are return on equity and cash flow to debt.
Okay, let me translate those for you listening. Return on equity basically measures efficiency, like how much actual profit is the company generating with the shareholders' money.
Right.
And cash flow to debt asks a truly terrifying question. If the economy freezes tomorrow, does this company have enough actual cash coming in the door to pay its lenders, or is it faking its health with accounting tricks?
And because SCHD demands a pristine history of dividend durability and passes those brutal health screens, its portfolio looks entirely different from FDVV.
No Nvidia, I'm guessing.
No NVIDIA. It has a highly defensive posture, focusing heavily on energy, consumer defensive staples, and healthcare. You are looking at top holdings like Lockheed Martin, Verizon, and ConocoPhillips.
Real meat and potatoes companies. I mean, they aren't going to invent the next AI microchip and triple in value overnight, but they generate massive, unstoppable rivers of reliable cash.
And the performance metrics reflect that defensive nature. SCHD experienced a significantly lower maximum drawdown of negative 16.86%.
So it was noticeably less volatile than FDVV.
Very much so.
Yeah.
And importantly, for pure income seekers, it provided a higher actual dividend yield, 3.3% versus FDVV's 2.9%.
See, this perfectly illustrates the trade-off for you. You cannot have it all. If you want to capture market-leading tech growth and accept the higher volatility that comes with it, well, FDVV's methodology is your tool.
Exactly.
But if your priority is income stability, lower volatility, and ensuring the companies paying you are actually durable enough to survive a brutal recession, SCHD behaves much more like a high-quality fortress.
It proves that dividend investing is not a monolith. You must look under the hood and understand the specific algorithm of the fund you are purchasing, or you might end up taking on tech sector risk when you thought you were buying utility sector safety.
So let's tie all of this together. We started with the question of whether bonds are dead weight dragging down your portfolio, and if dividend ETFs are the ultimate modern replacement.
And the reality revealed by the data is that they are not competitors fighting for the same job.
Right. They are entirely different complementary tools.
Bonds, specifically high-quality investment-grade bonds, are your shock absorbers. They provide the stable, predictable, contractual cash flow you need for near-term living expenses. Their entire purpose is to ensure you are never mathematically forced to sell your stocks at a loss during a market panic.
And the dividend growers, the high-quality equities, they are your engine. They provide the long-term capital appreciation and the rising income stream you absolutely need to ensure your purchasing power isn't secretly destroyed by inflation over a 20 or 30-year retirement.
They work together. But as we look at the macroeconomic landscape in 2026, I want to leave you with one final provocative scenario to consider.
Oh boy, okay.
We've discussed how bond prices fall when interest rates rise. And we've discussed how dividend stocks can aggressively slash their payouts during a severe economic contraction.
Right.
But what happens to a traditional portfolio if we enter a sustained period of stagflation?
Oh, wow.
A nightmare scenario where sticky inflation forces central banks to keep interest rates stubbornly high, which continuously punishes your bonds, while simultaneously a stagnant, suffocating economy forces companies to cut their dividends just to survive.
A double whammy.
Exactly.
Right.
Where exactly does the safe haven exist in a world where both assets are taking fire at the exact same time?
Man, that is a chilling scenario and definitely something to mull over as you review your own asset allocations today. You might really need to log into your brokerage tonight, look past the ticker symbols, and ask yourself exactly what mechanisms are running your money. Thank you for joining us on this deep dive. Keep questioning the conventional wisdom, and we'll catch you next time.